So, sorry for the interruption. But going through today's price action, we're going to be talking about the importance again, for those that are also joining, of consistent sizing through hard markets. A lot of points during our trading, we get that breaking point where we simply get a couple of bad trades, and that brings out a nasty temptation from within. It takes out the temptation of, what if I size a little bit more? All I need is a couple more points, right? So if I have, instead of that, let's say I lost 3 times in a row with 5 micros. If I size once with 10 micros, I can make back everything I lost and a lot more profit if my idea is right. That I that thought process, that temptation, is what leads most people to ruin. Of course, if you're right, you make a ton of money. But you being right is also bad, because it builds up a bad habit, a bad notion that you can do this again and again and again, and somehow it will work out. Now, there will be times where it will definitely work out, and you'll absolutely save your accounts, you'll absolutely make a blasted day, but the days where it will not, and you'll simply just blow your account or dig yourself in a big hole that will be really hard to recover from, or that you simply won't recover from at all, and you'll end up blowing your accounts. This is why, for me, at least with how I treat my funded accounts, I value always being strict with the same sizing. This way, according to my system, it doesn't mind how many times I lose, as long as I win once, and I win big in that once to make back the loss plus more. Now, of course, there are circumstances in the market that make me have to, let's say, cut the trade at a certain target to reevaluate it a bit more. For example, OPEX. You can't trust anything that happens in OPEX. So as much as I wanted to hold the trade all the way up, it was more doable to not. But that's not the emphasis. The emphasis is why it's so important to have the same sizing in any sort of scenario, or the consistency of the same sizing. Because let's say you have a sizing where you're allowed to be wrong 10 times and you blow the account. If you do not interfere with that sizing, and let's say your system offers that for every 10 trades you take, 5 are right, 5 are wrong. Let's say you lose the first 5, but you don't influence your sizing at all, then you're very likely that the next other 5s are gonna be right. And if you aim for a nice risk to reward, a 1 to 3 for example, if you win 2 times, you make back all those 5 losses and you end up in profit, as long as you're using the same exact sizing. Here, for example, we entered short. No, I believe we entered long first. Price was not doing anything. Cut. Paper cut right there. Alright. We entered short. Price wasn't doing anything either. Cut. Price is not telling me what I need to know. I took 2 losses with the same exact sizing. I'm a bit red on the day. I think at that point I was down 34 points on the day. Let's evaluate and wait for price to tell me what it really wants to do. Price starts to make some bullish movements, inverses this for Q3, another entry, same sizing. Made it all back, cut again, evaluate price, enter again, that was around here, and then cut again for max profit. By keeping that sizing continuously, I was able to end the day green with 2 wins versus 2 losses. So systematically, by lowering the risk, you are able to give yourself a lot more room to make profit, but also a lot more room to lessen your exposure to losing your account or letting your emotions get riled up. If by doing so, it grants you also the ability to also kind of create this adaptation, a mantle of, let's say, being able to control yourself and your emotions a lot more when you're red. Because I think a lot of us have issues where, if you get too much red, you kind of psych out a bit. You kind of stress out, you get frustrated. You know, here, yes, I was wrong a couple of times, but my mentality was the same. If the setup forms, I will take the setup. If it doesn't form, I'm fine being red on the day, I'm fine being down. It's not that urge of, okay, I have to take every single trade until something appears so that I can make some money. Or I have to take every single trade that comes out because I just do not want to end this day red. That urge, and of course digging yourself into a hole, is going to set you back completely. So the best way to manage yourself is with structure. Now, this goes on to, let's say, what an A-tier setup is. In this moment in time, we had no A-tier setups. Or at least the trade that we took was not an A-tier. The trade that we took was an early long that was confluenced with the idea of simply the 1 minute time frame. It was the fact that price failed to displace lower and created this divergence. After creating the SMT, it expanded higher. And remember that everything is fractal. And with everything being fractal, that means the following. The bow is the hourly time frame, the direction that the bow aims to. The string is the mid time frame, the way that you hold it, the way that you pull it. But what's the trigger for every single move is the small time frame. The small time frame is what leads to the mid time frame. The mid time frame is what leads to the high time frame, and the high time frame is what leads to the overall direction of the market. And the same can be said vice versa. When high time frame hits a pivot area, PD array, a liquidity, the small time frame will have a reaction that ignites the complete outcome of the high time frame. So that's why we end up using the high time frame as our bias, the mid time frame as our structure, and the 1 minute as our entry. Like a bow and arrow. You pull the string, you aim the arrow with the bow, and you let go and shoot. In this case, the 1 minute time frame was telling us it wanted to go higher. How high is unknown. It's just knowing that it wants to go higher, and high time frame has a reason to go higher as well, to potentially invalidate the PD rate that it had at hand in this moment, or to go for the 4-hour high that it had. That's the information we only had at that point. So it's not an A-tier setup. It's not a setup that you can just literally hold knowing that, oh, it's going to absolutely rip to the sky. Now, when price does not start as an A setup, that doesn't mean that you necessarily have to be super stressed about it, of course. Ideally, you want it to follow structure and follow certain things. Because as the price goes on, it changes its structure as more information or more data develops. This started off as a simple 1 minute Q3 inversion reversal with SMT, and it led to a 5 minute 2022 model. So in this case, this was, let's say, a B tier. A B tier soon turned into an A tier with the 5 minute 2022 model. Stop rate with the SMT and displacement with the 5 minute shift right here. The retracement to the PD array was the given sign that it was just going to completely continue going higher and that it was worth to hold till midnight, or potentially the external buy-side liquidity that it had above. As price does this, of course you can average up. If you, let's say you have a nice solid entry here, this would have been a key area to average up for sure. Or if you secured profit like I did, this would be your re-entry event once more. Ideally, by doing the same exact sizing every time, you're also mitigating the risk of what if this is wrong, right? What if I enter here and this trade didn't work out and it ends up stopping me out? Well, because I entered with the same exact sizing and I didn't over leverage or anything of the sorts, it's not going to be as hard as if, let's say, I entered twice my size here and I happen to be wrong, because now that I lost all the profit that I made previously plus a little bit of red. So, and ideally at that point, I believe that at that point the 4-hour time frame was looking a lot more better as well. So this can also go into how to hold the trade properly. Yeah, this was looking a lot more nicer at that point. So yesterday we were talking about how to hold the trade when it's A+. Now it's more of how to manage accordingly during rough markets, and as data develops, how to gather the confidence that price is going to go towards your desired draw, and how to hold for it, because we held our trades quite nicely throughout the entire session with confidence that it was going to hit, simply because data kept delivering more justification for it again and again and again. When price shoots up, you don't necessarily have to be worried about chasing it as long as data keeps unraveling. If it's starting from the 1 minute, that's fine. If it's starting from the 5 minute, that's also fine. But if it's concluding at the hourly time frames, like hitting hourly structure, hourly PD arrays, hourly liquidity, at that point you could say that you're pretty much chasing, especially if it's at a really, really high premium. At this point, you could say, okay, well, how do I know if this is not a high premium or not? Well, it actually is a high premium, because if we measure from the swing point from here to here, where does OTE end? Here. Equilibrium started here. So after this point, price is now moving in premiums. And when it starts moving in premiums, that's ideally where you don't really want to chase it. You want to be relatively careful and relatively maneuver around the bullish PD race if it happens to fail, because this is definitely a point where price could definitely fall. I believe that this is also where JD was looking for shorts at this area. Can you guys hear me? Test, test, test. Okay, perfect. Now, with the correct sizing, I would say it also helps out for Apex's scummery. You know how they want to see people that aren't like over leveraging, people that are trading properly. I think this also limits the room that they can have to say, oh, you can't get this approved because you DCA'd or something like that. And this also helps you to avoid DCAing in itself. With the lack of stress of what price is doing, it can do wonders to how you manage a trade. Because a lot of us have that issue of frustration where, oh, the trade isn't going my way, I should cut it right now because it's hurting me, right? With proper sizing, you know, I was in drawdown here. I'm like, okay, I'll just wait a bit more. No, didn't work out. Exit. Without it again affecting my nerves or my emotions. So the key takeaways for this is simply, ideally, right, you want to calculate the drawdown you have in your account. Let's say 50k account. The 50k account has a 2,500 drawdown. So a 2,500 bucks with what sizing gives me a statistic where it's impossible for me to blow the account just because of my how many times I'm right or how many times I'm consistent enough throughout the day. For me, it was 2 micros. 2 micros, I believe, is like, I think it was 500 points, more than 500 points. There's no point where I lose more than 500 points in a month. Or no, well, maybe, but no, not more 500 points than a week. And if I do lose more than 100 or more, it's likely that I'll make it back anyways. So that's why for me it was 200. It was a 200 stop limit of 50 points, because I would have to lose with 500. Keeping in mind, I would have to lose essentially like 10 trades in a row. But not just losing 10 trades in a row, but losing like actually 50 points in a row, which is not something I tend to do at all. So it's very unlikely for me to have that happen. And because it's unlikely, I can rely on simply just trusting myself that if I keep the same sizing and I keep the same risk to reward, eventually the wins will overpace the losses and it won't diminish everything I'm doing. Now, it is slower. Yeah, that's for sure. It is slower. Like, this has been a super slow process for me. But what's better, having a slow process and making actual money, like I'm about to make another payout soon, or trying to go really fast and then crash immediately in one bad day? I would consider 2, parasailing. And what's a normal loss with 200 daily limit loss? I would say, honestly, it's based on structure. Ideally 50 points, which is 200 bucks. I try and put it in between 2 trades. 25 points and 25 points stop limit kind of. It also depends on the quality of the setup. You could enter 1 micro first, and when it gives you that extra confirmation that price is good, you enter 2 micros, and that way you kind of allow yourself a lot more leverage and space for your trade to breathe. But of course, there are times where Nasdaq simply moves too volatile, and that happened to me once where Nasdaq was moving. Remember when it was moving 50 to 100 points in 1 minute candle? I tried entering a trade. I got locked out. The same exact idea that I took, I got locked out on a manipulative move, and then price shot up all the way to my target. My evals made money, but my fundeds didn't, and that was a sucky scenario, but it happened. So ideally, my recommendation is when you are engaging into the market, you want to measure the candles that are happening right now. So simple, right? You see an expansion happen, you draw it out. All right, let's see. This expansion happened was a 36 point candle. Okay, let's measure a different big candle just to get an idea. This sell-off here was 15, 18, 8, followed with 18 again. So from here, you can get the idea that the candles aren't too wide. They aren't too violent. It is moving fluidly, but it's not in a position where it's just dangerous that you can not manage it correctly. That's how I like to do it. If I see that the candles are too wide, too volatile, too immense, that would practically run through my trade even if I tried it with 1 micro, then just don't trade the day. A lot of people think that not trading is... A lot of people think that they have to trade every single day. That's wrong. Ideally, you only want to engage into the market when you are confident of what price is doing. If you look at the market and you see the price action is awful, then go away. You don't need to trade that day when the probability of you losing money is there, greater than anything. I myself, if I didn't have a responsibility with Kingline, I would never trade OPEX. I would never trade NFP protocol. I would just go around my day and let price do its thing, and I'd come back to it if I see a setup that I think is high quality and that has to, like, it's going to work, because there's a difference in the confidence that you see. For example, when I saw that 5-minute 2022 model today, it was a absolute confidence that, oh yeah, this is gonna send it to the buy side, and after the buy side all the way to midnight. The confidence was there because the structure was easily readable. It had the whole narrative going for it. If you wake up and you see the chart, and that's why for me, I don't mind waking up at any time during the market. Some people like to wake up way early to try and catch moves. I don't really mind any time because I know that I open the market. If I know what I'm going to see and what I read, I'll be there. I'll be able to catch it. If I don't see anything, then it's okay. Because ideally, like we know statistically, day traders are... well, yeah, you're learning. So it's, you got to take your time, of course, with hours in the chart. But day traders statistically are not profitable. It's a really small percentage that are profitable. People that are profitable, those that take their time looking at the charts every now and then, and if they see a setup, they strike. So you want to trade always when the circumstances are in your favor, when things are in your favor, when price action is in your favor, when time is in your favor. If you're seeing time distortion where price is doing one thing on one index and price is doing in the other and it's just choppiness, don't even bother taking a trade. And of course, if you do try to, then make sure that your sizing is adequate so that this choppiness doesn't scare you off, because I bet you there's so many people that in this exact scenario right here where we were, they entered long, they cut. They entered short, they cut. They entered long again, they cut. They entered long again, they cut. They entered short, they cut. Bunch of trades in this area, indecisive of where price is going to go, every single time sizing a little bit higher because they were like, oh man, if this time it does expand, everything is going to work out. But if it doesn't expand, then, burns until it reaches a point that, let's say you're right? Let's say you go long here and it worked. You made back your loss. But let's say you failed, right? Let's say you actually went short the second time because, oh, the CB right here, Tyrant went short, I'm going to go short here, over leverage because I want to make back everything that I lost here. I know that if it hits this low, I'm not going to make it all back, so I need to go like 5 times my sizing. Blown the account. Or let's say you do go long, you bank, you made back all of the loss. That develops an internal bad habit. Trust, the bad habit that comes out of that is big, because next time this is going to happen again. And next time your brain is going to think, well, it worked out once, I'm going to try it again. And the next time that you try it again might be the time that you actually just blow it. So if you enter once, like I said, the rule of 2, if you enter long, it doesn't work, and assuming right, you have a whole narrative and reasoning behind why you enter a trade. It's not you just randomly entering the trade. If I think price is going to go up and I enter long, bam, damn, I got stopped out. Well, I guess it's going lower. I see the structure and reasoning why it would go lower. My bullish setup is invalidated. Okay, I'll go short. Bam, got stopped out. That's your sign to take a pause, to reevaluate what the market's intentions really is in this moment. Because the market is always in pursuit of something, internal or external liquidity, or just with the intention of choppiness. It is always trying to do something specifically, and after you get stopped out twice in a row, either long or short, there is something specific going on. Either it's chopping, and if it's chopping, you gotta wait for more data. If it's not chopping and it's just manipulating, you still want to wait for more structure to clear, because at this point, entering back and forward is going to do nothing. Entering one trade lightly, with no stress that it does all of this, doable. Oh, invalidated my idea? Fine, you cut, you wait for the next one. But keeping that sizing consistent, not being tempted to over leverage, and not flip-flopping around, instead just being patient and waiting for things to be clear is so much better than that as well. And the idea is that you guys start building good habits when it comes to trading, because if you feed the bad habits, you're going to have a really rough time trying to do anything. Honestly, the highest confidence trade here was only the 5-minute one that came a lot after. Even the long that I took around here wasn't really high confidence for me, but I was willing to take it because I was risking it on evals. But this right here, this was the chef's kiss that ideally, this is what it means to be patient and to wait for data. To wait for the structure and the price to tell you what it truly wants to do, instead of you trying to guess it and force it to do what you think it wants to do. So the question is, how do we learn to have better discipline? Putting rules to yourself and enforcing those rules, I would say, is the best way. Limit yourself to take only a certain amount of trades per day, not every setup you see. Limit yourself to, in certain accounts, only to take A trades. Limit yourself in certain accounts to only take B trades. If you only have one account, simple. With that exact account, change your sizing based on the tier of the trade. If it's a C tier, enter just one contract. If it's a B tier, enter 2 contracts. If it's an A tier, enter 3 contracts. That way you can diminish the risk, and you can also put yourself in a scenario where you're only being picky of what price might do. Another also alternative is cap your sizing as well. Do not allow yourself to go over certain sizing. Do not also allow yourself to take more than a certain amount of losses. The rule of 2 that I have for myself is really clear, because you should not be wrong 2 times in a row unless the market is in a search and destroy mode. And if it is, then okay, well, you just wait and you identify again. But if you're wrong 2 times in a row and you have no idea where price is, then it's really just no point in even bothering trading it, because you don't know what it's doing. You might as well wait. I still can't tell why it's better than the earlier set there. Each one is inverse to CV. Is it because of I don't know how to, is it B or C? Okay, it's better because, remember, think of it like this. At least for me, this is how I perceive it. If high time frame is in confluence, if mid time frame is in confluence, and if 1 minute is in confluence, that's A. If 1 minute is in confluence, if mid time frame is in confluence, that's B. And if it's just 1 minute, that's C. Here, in my opinion, we didn't have anything other than an SMT and the inversion of the 1 minute CV. That does not mean that we are going to super expand upward. That just means that we have the possibility of doing so, but we could have by all means rejected 953 right here and then just done that. There's nothing really giving you that high probability that this was going to happen or that we were going to pursue these equal highs. But by the moment more data developed and we closed above 953, used it as support, broke through these highs, and the 5 minutes started to develop structure, because keep in mind, at that point, at this point right here, let me just replay the chart. In fact, this is all the information we had. We broke through the 5 minute fair value gap. We were holding in the 5 minute order block, the 15-minute time frame. We inversed the 15-minute time frame. 4-hour time frame at that point. Okay, well, it doesn't show the 4-hour, but it was looking like it was going to wick down. So there was a lot of different things conflicting at that exact point, which did not allow it to be a super quality setup that you would look for. Of course, it's a setup you can take, it's a setup you can risk, but not the highest quality that it could be. Right after, where it made the 5 minute 2022 model, let me show you the difference of how price looked. So, we have the 5 minute 2022. If you go to the 15-minute time frame, the 15-minute time frame now overcame the 15-minute inversion. So bearish PD rate has been broken. At that very same time, the 1 hour overcame the 1 hour CBD here that it was struggling so much to break before. So now we're having high time frame and mid time frame confluencing for the move upward. And if we go back to the 1 minute right there, we also had price close above TMSO, we had price inversing this right here, and we had price closing above 1034 for another quit, just slapping it pretty much there with a stop loss underneath here. So everything was then went from one thing confluence in one time frame to everything starting to spinning into a bigger confluence for everything else. That is why for me, this was the highest confidence trade. This was not. This was something I took, but this was something where I took and I felt like, okay, now this can really go. Any other question? Okay, we can go through that, right? So it's really fractal. You know, if you have a trouble perceiving white time frame, let me turn the word right. If you're having trouble to confirm how a high time frame confirms a setup, think of it fractally. Treat the 1 hour like if it was the 1 minute, just that perception. If you know what you need to see for price to respect a PD array, a liquidity, a soup in the 1 minute time frame, then you can just perceive that as if it was the hourly time frame as well. So if I'm treating the 4 hour as if it was the 1 minute time frame, what do I want to see in this 4 hour busy? I do not want to see price close below here. Oh, price closed at the 50% and it's pushing right back up. Then if I'm perceiving that like a 1 minute time frame, then this is ideally being respected for a period to go where? Here. Or let's say right here. How do I perceive this as, let's say, a 1 minute setup? Well, it took out the high. If it traced to a 4 hour busy right here, respected it still. Ideally, if this was a 1 minute setup, what can we expect? Well, to push all the way to this fair value gap right here, or this area right here. The difference is really simple. It's just perceiving it as if it was a different time frame. So if you know that for a 1 minute setup to be confirmed, you need a stop rate, you need a market structure shift, you need a PD array for price to close above the 50% of a PD array, or to make a swing low or swing high in that PD array, then you go to high time frame, and if you're seeing exactly that, that's how you know that it's being respected and that it wants to give that ideal move higher. Yes, Parvez, this is recorded. You always want to think of it like a bow and arrow, really. I think that's the best approach for it. High time frame is your direction, mid time frame is the well, the string, and the arrow, and you letting go of the actual bow is the 1 minute. And that's why ideally you want to base your targets on the current structure that you're trading. So what I mean by that is, let's say the 4-hour time frame is in a 2022 buy model. If the 4-hour time frame is a 2022 buy model and you're a swing trader, then you want to aim for 4-hour liquidity. If let's say there's a 5-minute model like the one that we had right here, you want to aim for 5-minute liquidity. So what would the 5-minute liquidity look like? It would look like this one right here, and it would look like this one right here. That's what the 5-minute liquidity would look like, and that would be your targets if you were to participate based on a 5-minute model. What if you participate based on a 1-minute model? Well, your target should be 1-minute liquidity. An issue that also comes is that people don't really know until when to hold it. Well, you can also hold it based on the structure at hand that your reasoning is behind for the trade. What's the 1-minute external liquidity here? So in this range, I'm going to draw a couple, and I'm going to ask you guys, and you guys are going to tell me which one it is. So, is it this one, or this one? 1, 2, or 3? Give it a couple of seconds for you guys to answer. It's kind of an obvious question though. Alright, only one person answered, don't worry. Yes, it is the one. This is the external liquidity. So if you're going long based on a 1-minute model, this is your target. If you target any higher than this, the probability is that you might not score it if it's only a 1-minute model. Now, of course, as things unravel, if it starts to develop into a mid-time frame model, then you can start targeting mid-time frame liquidity. But you always want the liquidity that you're targeting to match the structure that you have in the time frame that you're playing. That's why I like to trade 10 a.m. because 10 a.m. is when the 4-hour candle opens. I like to target, you guys know that on good days especially, I have a 70 plus profit day because I use the 4-hour expansion to target 4-hour liquidity. I don't rely on the little moves that happen in mid time frame of 1 minute because I prefer to trade it once it starts happening based on the high time frame. But that's just me. So that's a thing to keep in mind as well. Your targets should be based on the structure and reasoning of that structure of why you would take it. An example of a 4-hour play, let's see. Nasdaq has been so nasty that I'm not sure if we'll be able to find one. Never mind, we did find one right here. So you can say that this was right here, stop rate. Price completely ate up the move and made this 4-hour inversion right here. Now let me ask you, if this was a 1-minute time frame setup, would you risk entering a short here? Keeping in mind it also has all of this equal low liquidity right here. Of course, let me just, so you guys don't cheat. If you saw this in a 1-minute time frame setup, would you take that for a push down to this liquidity here? Right? So if you would take this, or if you think that price could go lower based on the 1-minute time frame, if this was a 1-minute time frame, then this is technically your bearish bias for the hourly outlook that's going to try and pursue down there. So that's an example right there. It's not the most beautiful sample. Back in 2023, I remember seeing some 2022 4-hour models. Nowadays, I don't even think I've seen one in a while. But it does appear at times. I don't really look at it much because I'm not a swing trader. 4-hour models are usually traded by swing traders. The RR is bought there. Let's see. If you entered here, the invalidation of the trade would be up here, and your target profit would be right here. So it's technically a 1-to-1. If that is not in confluence with your model, then there's no reason for you to take a 1-to-1. Oh, you mean, okay. So the way that I use the 4-hour candle for my trades is kind of like the power of 3. So every candle has accumulation, manipulation, and distribution in it, right? So ideally, you want to try and catch the manipulation or the distribution that the 4-hour candle has. The way that you can do that is actually like the open low high close, or the open low high close of the candle. Before, when I didn't know how to do it properly and I was just learning how to do it, I used this indicator to help me out. Of course, it's by this guy. So I use this candle or this indicator here to help me out with it. So ideally, that the way that it would work is that you would want to base your trades on the following prospect. Let's say I'm still bullish here. If I'm still bullish here and I see that this is the 4-hour candle, then ideally from any point here, if we make a bullish setup, I can look to enter the bullish setup knowing that this is likely going to be the area the price is going to come towards, in the assumption that this is going to be manipulation lower. Now, we're not bullish right now, but assuming, right? Let's say the price has bullish structure, blah, blah, blah. If price comes down here, I'm assuming that this is manipulation, so the price can then distribute to turn this candle from bearish to bullish and then start to expand higher. So this would help me measure how the 4-hour candle can potentially expand to which liquidities around it. If I'm let's say taking this as a 1-minute model, right? Let's say the order block right here. I'm going to enter the order block right here as a 1-minute model. The 1-minute liquidity I should target would be this. But thanks to the 4-hour candle and the possibility of greater expansion, I know that I can actually target this right here, the 4-hour open. I can then proceed to target what could be the 4-hour high, which is this right here. And I know that the very bottom of this, assuming that this is the manipulation right now going lower, I want to enter a trade within this area. I do not want to enter a trade after price has gone above this, because then this is going to be kind of chasing the 4-hour expansion. And by chasing the 4-hour expansion, you're kind of putting yourself in an awkward position where if you're wrong, it's going to come right back down against you. This is the power of 3 by 2. I don't even know how to say his name right. 2 the G's? 2 the G's? You just search up PO3 and it appears right there. 2 degrees. I now do it kind of visually, so I don't really need the indicator, but it's a great help if you're beginning for it. Gives you that outstanding little... It helps with targets, it helps with bias, and it helps knowing when price is ideally manipulating or when it's distributing. It's a nice little mix of both. Any other questions? I've never tried that one, but I would encourage that you guys actually explore. So if you think one is better than the other, go for it. I think it's really important to cement in you guys' head how badly you want this to work for you. I'm sure all of us have had scenarios where we reached our highest point and then we fall off when we were so close to it. And it's always because of the trade management in the end. It's really important that we start to cement in our heads that If we want to succeed and turn this business into a lifelong prospect that will set us and our families wealthy, or at least a better life, that there's certain things, disciplined wise, that we need to commit to and do to make that happen. The discipline of not letting your emotions get to you by reducing the risk to the point that it feels like a little poke instead of a stab wound is essential. I've been trading for 5 years and I've only been profitable for like two, kind of one, because 3 of those years it took me freaking forever to learn that aspect. No matter how many times you guys try and rush it or try and put that process in of just over leveraging, sizing inadequately, you guys are never gonna go anywhere, as rough as that sounds. It's a growth game, really. It's a long-term growth game. It's not a, oh, 1 week is gonna be amazing and that's all I need. No, it's you need every month to be amazing. One bad day can happen and it can all be fine, but as long as you have green months, that's what matters. And yes, as DLC says, every time we rush it, we're delaying it for our families. So as you guys see me navigate price, and ideally there's other people that might flex that, oh, I have a higher win rate, oh, I have all of this, I make so many points in 1 week. They do not show their losses. They don't show how even though they made so many points that 1 week, they probably lost it all the very next day. But they hide it because they can't let people know that. You guys seeing how people, or well, let's say profitable people, lose and recover, and how they recover, not by gambling, not by full porting, but by consistently doing the exact same thing, is what you guys need to do yourself as well. It's the same repetition, risk parameters that make you have your edge and do not put you vulnerable to failure, and also trusting that there's always going to be a market to trade the very next day. It's not gonna disappear on you guys. There's not gonna be a random day where just the Nasdaq shuts down. It would always be there, so there's no rush to trade every day. There's no rush to trade a bad session. Trade the sessions that are easier for you. Trade the PA that makes you think, oh, this is super easy read. And if you don't know how to read the market, then that's why you're here, to also learn. But as you learn, to learn the good habits. If you ever feel frustrated by price, that's your sign that this is not what you're supposed to be doing right now. If price is frustrating you, that's the sign to leave the charts, take a break, or to simply not trade the current day. Because trading shouldn't be too frustrating. And that took me a long time to learn. That trading didn't need to be stressful. It should be easy. It should feel like the easiest thing in the world. Which at some times it is, right? When we catch those bangers with no stress, easy peasy, made money within minutes. Because that's how it's supposed to be in easy conditions. In hard conditions, oh, that's a nightmare. But survive the rough markets to thrive in the easy ones. This week, for example, I did not trade Monday. I did not trade Tuesday. I did trade it, but I was flat on my fundeds, right? Because there was nothing there for me. And now, I'm $200 away from being able to request another 40,000 payout. And I'm going to be up 80 grand on the year. And you guys saw me, I joined Kingline on what? I joined Kingline, I think it was around April, maybe February. All that time with you guys, I've been slowly nudging it. Getting there, and now I'm reaching the point where I'm starting to get that spiral, and it's just going to continue going like that, because we're going to keep doing it slowly, we're going to keep doing it disciplinedly, and it's showing you guys that by implementing this again and again and again is how you really do it. It's doing the uncomfortable things that makes the difference. It is the forcing yourself by a lockout, by simply shutting your charts, by simply waking up and saying, nah, I'm going to skip trading today because it's NFP protocol. How did you finally manage to control the emotional roller coaster when you were in the right side of the trade and let the trade run and not choke it by taking profit early? I started to kind of care less. I was really stubborn, so I learned through a lot of loss. Like, I literally lost all my trading money and I had to get an actual job planting tomatoes in Colombia to make money to come back to trading. So I learned through losing everything again and again and again to finally stop losing and doing different things. I would say that it's really learning to detach yourself from the trade outcome. When you enter your trade idea, you have your target, and that is your final target. You don't care about what happens after it runs through that target. You only care until it hits that. For example, today my target was midnight. If it ran through midnight, I knew it was going for buy side. But if it didn't run through midnight, I knew it was going to go for sell side next. Whatever the outcome is, I do not care. I only care about price hitting midnight and then taking my profit and just letting it be. If I feel uncomfortable because price is doing certain things, or let's say it's OPEX, that I don't trust NASDAQ, then I'm going to secure a target that I feel comfortable with, and I will not regret it because I know that the very next day there might be a good setup I might take, and I'll make back my money, or may make back more. For example, today I only made $100 in my fundeds. I could have definitely made 400 if I held the trade like I held my evals, but I don't care because I know that if I keep doing it, I'm eventually going to compound. Do not underestimate the power of compounding gains. The more you compound, the bigger the snowball is gonna get. You roll it, it's tiny at the beginning, but as you keep it going, it becomes bigger and bigger and bigger until you pretty much have a pot of gold. First payout, it took me 2 months to get that 40K. 2 months of just grinding it down. But if you think about prospectively, imagine making 40 grand in 2 months just by working 1 hour a day. That's fucking amazing, right? You don't need to make it in a day or in a week. You just need to make it in general. And as they always said, the greed, the desperation, the rush to become great will always hold you guys back, especially, like I'm telling you, I never judge retail traders except HGT because just to tease them. But retail traders that are profitable, never judge them because they have great risk management to become profitable. There's a running joke even in the trading industry that ICT traders are unprofitable as heck. And that's true because they don't know how to do risk management. I have friends that have been trading for so long and they suck. That I've taught them and they still suck because they just don't want to learn the proper steps to do proper risk management. And I'm telling you, not only as your mentor but as your friend, none of you guys will make it unless you master the art of losing. Once you learn how to lose properly, you're gonna grow exponentially. Because really in this game, the best loser wins. Alright, do you guys have any questions before we end the class? Alright guys, then I hope you have a good rest of your weekend. This is uploaded, so those that missed a little bit of the beginning, do not worry. We talked through the importance of consistent sizing. We talked about how to hold a low tier model as it develops into a high tier model, and it was a little bit of a rant, a little bit of wise lectures. Alright guys, see you on Monday then. Have a good weekend. Bye bye.